Did you notice the thumbnail of this video? I wonder if Warren Buffett had told me these 6 rules 30 years ago, I would be one of the world's billionaires by now. I'm just kidding. But the truth is that Warren Buffett's 6 investment rules have helped me a lot on my way to becoming a millionaire. For many years, I have built my wealth by following these investment rules. Warren Buffett's method is not about chasing quick profits but investing with discipline and intelligence. Today, I will share with you the 6 rules that have shaped my financial success. If you find this information useful, don't forget to like, share, comment and subscribe to Watch to Get Rich for more information on how to build wealth. 1. Always have cash on hand. One of Warren Buffett's most brilliant investment strategies is to maintain cash reserves to take advantage of market downturns. When panic strikes, many investors sell assets at a loss, creating an opportunity for those with liquidity to buy valuable assets at a discount. A prime example is the 2008 financial crisis, when Goldman Sachs faced serious liquidity problems. Buffett invested $5 billion in the company through preferred stock with a 10% annual dividend, plus stock options. When the market recovered, this move made him billions of dollars. Tip: always maintain an emergency fund and investment capital to take advantage of market downturns. When fear drives others to sell, it's your opportunity to buy quality assets at a discount. 2. Invest, don't speculate. One of the biggest mistakes investors make is chasing high returns without considering the risks. They get lured into speculative activities, hoping to make quick profits, only to suffer heavy losses. Buffett takes the opposite approach, investing cautiously and ensuring that his capital is protected. A prime example is the 2008 financial crisis. While many investors panicked and sold their stocks, Buffett remained calm and deployed his capital strategically. He invested $3 billion in General Electric, securing favorable terms that guaranteed high returns when the market recovered. His patience paid off, turning those investments into billions of dollars in profits. New investors often get caught up in the stock market craze, buying trendy companies without understanding their fundamentals. Take the dot-com bubble of the early 2000s, for example, when investors poured money into internet companies with no real revenue, only to see their investments wiped out when the bubble burst. Tip: to follow Buffett's strategy, focus on companies with solid fundamentals. Avoid speculative investments and don't let emotions dictate your decisions. 3. Invest in what you understand. Buffett never chases trends or invests in industries he doesn't fully comprehend. This is a rule I live by and one that has saved me from many potential financial missteps. The rise of cryptocurrencies and NFTs has created countless overnight millionaires, but it has also left many investors empty-handed when the hype fades. Many people get swept up in the excitement of new financial instruments without fully grasping their underlying value or risks. For example, instead of speculating on complex financial instruments that I don't fully understand, I invest in businesses like Apple and McDonald's, companies that produce tangible goods and services with predictable cash flow. Apple is not just a technology company but a brand ecosystem. Its revenue streams from iPhones, MacBooks, and services like iCloud and Apple Music ensure consistent earnings. Similarly, McDonald's isn't just about selling burgers, it's also a real estate empire, owning prime properties worldwide and leasing them to franchisees. Buffett has long held significant stakes in Apple because of its strong brand, loyal customer base, and consistent revenue streams, which offer long-term stability and growth. Understanding the inner workings of a business before investing is crucial. Many investors chase emerging trends without considering whether they understand how a company generates profits or sustains itself in a competitive market. Tip: before investing, ask yourself, do you really understand how this company makes money? Can you explain its business model in simple terms? If not, it might not be the right investment for you. 4. Focus on quality businesses. Buffett only invests in businesses with strong competitive advantages, what he calls economic moats. These companies dominate their industries, generate consistent profits, and have exceptional management. A company with a strong economic moat can withstand competition and continue to thrive for decades, ensuring sustainable growth and profits. Take Coca-Cola as an example. Buffett has held Coca-Cola stock for decades because it is a globally recognized brand with unwavering demand. Even during recessions, people still buy Coke. Brand loyalty, efficient supply chains, and a vast distribution network give Coca-Cola a lasting competitive advantage. In a similar way, Amazon has built a logistics empire that is virtually unmatched by its competitors. The company's investments in fulfillment centers, Prime membership, and cloud computing through AWS have made it a dominant force in e-commerce and technology. With billions of dollars in free cash flow, Amazon continually reinvests in innovation, further solidifying its market position. Another great example is Apple. With strong brand loyalty, an ecosystem of connected devices, and high-margin products, Apple generates huge profits year after year. The company's ability to innovate and maintain customer loyalty gives it a long-term advantage in the technology industry. Tip: look for companies with low debt, high cash flow, strong leadership, and sustainable competitive advantages that allow them to remain profitable in good times and bad. 5. Be patient, think long-term. Buffett famously said, "The stock market is a vehicle for transferring money from the impatient to the patient." The best investments take time and require discipline. Buffett himself demonstrated this principle when he bought shares of American Express during the financial crisis of the 1960s. At the time, the company was in the throes of a major scandal, and many investors fled in fear. However, Buffett recognized the power of the brand and its resilience. He held onto those shares for more than 50 years, turning a modest investment into billions of dollars. Another great case study is Coca-Cola. Buffett began accumulating shares in the 1980s, when the company was already a well-established brand. Instead of selling for short-term gains, he held his investments for decades, benefiting from the company's steady growth and compounding dividends. This long-term thinking is what separates the most successful investors from those who buy and sell based on market fluctuations. The ability to withstand market downturns, focus on company fundamentals, and allow investments to grow over time is crucial. Tip: buy great businesses and hold for decades. Short-term thinking destroys wealth. Patience and faith in your investments will lead to true financial success. 6. Daily news will kill your investments. If you listen to financial news every day, you will be bombarded with hype, fear, and constant predictions. The media thrives on sensationalism, often exaggerating market movements to attract viewers. Many investors react impulsively to headlines, making emotional decisions that cost them dearly in the long run. For example, in early 2020, the COVID-19 pandemic caused a historic market downturn. News of the outbreak flooded social media, and panicked investors rushed to sell their stocks, fearing a prolonged economic collapse. However, Buffett stuck to his approach, held his ground, and even looked for new opportunities. His deep belief in the resilience of high-quality businesses helped him weather the downturn. Indeed, the Dow Jones recovered from its March 2020 low to a record high within 2 years, proving that patience and discipline pay off. The lesson here is clear: don't let media-driven fear drive your investment decisions. Instead, focus on fundamentals, business performance, and long-term value. Market news is designed to provoke a reaction. Smart investors remain calm and rational, sticking to their strategies regardless of the outside panic. Tip: stick to the fundamentals. Analyze the intrinsic value of your investments and don't let daily headlines or short-term fluctuations distract you. Another important thing that I think is not a principle but a philosophy for success in any field, not just investing, is invest in yourself. Investing in yourself is the most valuable investment you can make. Buffett credits much of his success to lifelong learning. He reads over 500 pages of material every day and emphasizes the power of communication. In fact, he once said that improving your ability to communicate effectively can increase your lifetime income by 50%. I have spent years attending business seminars, reading financial books and hanging out with high-level business people. The best investment is not stocks, but your knowledge and skills. Tip: develop your financial knowledge, improve your communication skills and never stop learning. Buffett did not become one of the richest people in the world by gambling or following trends. He took a disciplined and rational approach to investing. If you want to be financially successful, start applying these principles today. Remember, wealth doesn't happen overnight, but with smart decisions and patience, you can achieve financial freedom like Buffett. Now, let me ask you, which of these rules have you followed and which ones will you start implementing today? Please comment below the video to prove that you really want to become rich and build a life of financial freedom. Thank you for your support.